Good day, viewers. Today we'll be discussing an aspect of macroeconomics, which is national income. You see, each and every country engages in what is called an economic activity, and this economic activity is just an activity that an individual engage in order to produce goods and services by using the limited resources, the scarce resources, or even the factors of production available in the country, so as to generate income. That's the major aim there. And you see, since this economic activity, in one way or the other, determines the health of the nation, as well as the improvement in the standard of living of the people, it's now become necessary for the government to devise a measure or establish a metric that can be used to measure the economic activity, and that's why economists resort to a measure known as the national income. Now, what is national income? The national income is just the money value of all the goods, or we say the market value of all the goods and services produced in a country in a year, within a year actually. So the national income is a money value, that is, anything that can be measured in terms of money is what we include in the national income, and it also measure the flow of goods and services, and mind you, this flow of goods and services are those goods and services that arise from current production. That is, those that are produced just within a stipulated time, which is 1 year, that is annually. So each of these key terms are very, very important. They shouldn't be excluded from our definition while defining national income. So we can say a national income is simply the monetary or the money value of all the goods and services produced in a country from current production within a year. And you see, there are different methods of measuring this national income. Now let's look at the methods of measuring national income. So we have the product method. There are four, to be precise. There are four. The product method. So we have the income method. Three, we have the expenditure method. And lastly, we have the value added method. Now, what is this product method? How do we extrapolate national income by using the product method? You see, what we do here is to sum up the total value of all the final goods and services produced. Just before that, I forgot to give an example of economic activity. You see, economic activity are very many in a nation. It ranges from agriculture to construction, mining and quarrying, and even the service of doctors, lawyers, all fall under economic activity. So when we are now looking at product method, you see the summation of all of the economic activity rendered is equals to the national income by using the product method. That is, what is the value of agriculture that has been gotten from a particular country, the value of construction, the value of that a doctor has rendered, the value a lawyer has rendered. Summing all of them up will give us the value of national income by using the product method. And before I proceed to the next method, we need to know that Using any of this method will give us the same value of national income. Either you use the product method, the income method, the expenditure method, the value added method, you arrive at the same value. And okay, that being said, now we move on to the income method of measuring national income. You see, when we are looking at the income method, we are trying to sum up all the total income received by all factors of production in a country. As we are expected to know, there are 4 factors of production: the land, the labor, capital, and entrepreneur. And each of these factors of production have their respective rewards. And for land, the reward is rent. For labor, the reward is wages and salaries. For capital, the reward is interest. And entrepreneur, the reward is profit. Now, summing up each of these rewards is what gives us the national income by using the income method. That is, all the income which accrues to each of these factors of production is what is summed up, and whatever we get here will also be equals to the value of national income we get by using the product method. Now, the expenditure method. What the expenditure method takes look at is the expenses aspect of each of the agents in the economy. In other words, what we are saying is that we sum up the expenses made by household plus that of businessmen plus government expenses. Then we also sum up those goods we exported, that is, they are part of the production in our country, so we need to add it and subtract the one that is not produced in our country. Since we said the national income measures the flow of goods and services that is produced, or goods that are produced within a country, so any goods imported is not produced in Nigeria, so therefore we need to subtract these imports. And lastly, we have the value added method. The value added method actually takes into consideration the value of goods and services added at each stage of production. So we are going to take, for instance, let's say we have the value of output here, and we also have intermediate value here. Now let's say we have firm A, firm B, and firm C. So firm A actually is is a businessman, and, or let me say, is a farmer, and what it does precisely is to extract cotton from a tree and sell it to B. B convert the cotton to clothes, and firm B now sells that same clothes to firm C. Probably what firm C do is just to design the clothes. So firm C design the clothes. All right. Now let's assume that the value of the cotton when it was extracted from the cotton tree was 2,000 naira. So that would be the amount it was sold to firm B. Firm A sold the cotton to firm B at the rate of what, 2,000 naira. However, firm B, who converted the cotton to clothes and added an additional value to that cotton, the value was 350 naira. So the value of output by firm B now we can say is what, 2,350. And let's also assume that firm B sold that same clothes to firm C, and firm C added another value to the clothes by designing the clothes. And let's assume firm C added a value worth 450 naira. So the total value of that clothes now, or the additional value, that will be 2,350 plus 450. That's 2,800. Now we can say that the intermediate value here is simply 2,000 naira. It's simply 2,000 naira. Yes, 2,000 naira. And that's because that's just the initial value added to the cloth. Then after that, there was an additional value by firm B, and the additional value was 350 naira. And by firm C added a value of what? 450. Now if we sum up all of these intermediate value, then we'll arrive at what? 28. That will be 2,000 plus 350, 2,350 plus 450, 2,800. You can even see that the value of the output method, the product method is also known as the output method, sorry. So these are the value of the final goods and services produced, which is 28, and which is also equals to the value of the value of the summation of all intermediate value. And we know that the value added method takes into consideration the value added at each stage of production. So when we sum up all of these, that's when we have the value of the national income using the value added approach. Thank you very much for watching this video. Please do not forget to give it a like and also subscribe to my channel. Thank you.